Most people think a price just goes up until it stops. But what if that's not the whole story? Let's talk about gold and silver. Honestly, everyone wants to know when the ride ends. The real question isn't just about a top, it's about what comes after. You see, a peak isn't a finish line, it's a trigger. So how much longer can this go on? Look, nobody has a crystal ball, but we can look at the signs. The climb feels relentless right now, doesn't it? It makes you nervous. It makes you excited. Both feelings are dangerous because markets don't care about feelings. They operate on something colder. So let's strip away the emotion. What's actually pushing gold higher? Is it fear? Is it something more practical? And what about silver? Its story is tied to gold, but it's different. It's more volatile. It's more industrial. That duality matters. When gold runs, silver often races to catch up. But that race has its own limits. We've seen this movie before. The ending is never the same, though. The characters change. The world's financial backdrop changes. Right now, the backdrop is complicated. You know the headlines. Inflation, debt, geopolitics. They all feed the narrative. They feed the demand. But demand has cycles. Nothing goes in one direction forever. So how do you spot the turn? It won't be a single headline. It won't be a loud crash. Tops are processes, not events. They are slow and then sudden. Think of air slowly leaking from a balloon. For a long time, you don't notice. Then the shape changes. That's what happens here. The momentum starts to fade. The rallies get weaker. The drops get sharper. People will dismiss the first drop. They'll call it a healthy correction. And maybe it is. But the second one? And the third? That's the pattern to watch. It's a loss of conviction. So back to our first question. How much longer? The truth is we are watching for that loss of conviction. Look at the charts from past cycles. They don't just show peaks, they show exhaustion. That's the phase we need to identify. Are we there yet? Probably not. But are we closer than we were a year ago? Almost certainly. The higher it goes, the fewer new buyers are left. That's just simple math. Eventually, everyone who wants in is already in. Then who's left to buy? That's the moment the music slows. For silver, this dance is even more frantic. Its industrial demand can suddenly soften. If the economy hiccups, silver feels it twice. Once as a metal and once as a money. So what happens after the top? This is the part nobody likes to talk about. It's not a straight line down. It's a series of brutal rallies and deeper lows. It traps people. The first big drop will bring in bargain hunters. They'll think the sale is back on. Sometimes they'll be right for a week, maybe even a month. But the trend will have changed. The news will slowly turn. The stories that fueled the rise will lose their power. Headlines will shift. Suddenly, analysts will talk about alternative assets. They'll say the fear trade is over. The narrative machine will move on. And the slow bleed begins. Gold might hold up better than silver. It usually does. It has deeper pockets, a longer memory. Silver can get ugly. Its corrections are legendary. So is this all doom? No, it's just a cycle. Understanding the cycle is your only advantage. Because after the top, opportunity doesn't vanish. It just changes form. The mania leaves value in its wake. But you have to be patient. You have to be quiet when everyone is loud. And you have to be ready when everyone is tired. That's the real game. Not guessing the peak, but surviving what comes next. Let's be clear about one thing. A top isn't a price point. It's a psychological event. It's the moment consensus shifts from how high to how low. We aren't there yet. You can still feel the bullishness, can't you? The doubt is still a whisper. But whispers can get louder. They often do when prices get choppy. So watch for the chop. Watch when new highs feel labored. That's the first real clue. Now, history shows us something interesting. After a major peak, gold doesn't typically crash to its starting point. It finds a new, higher floor. All that fear and money don't just disappear. They recede. They consolidate. Think of it like a coastline after a storm. The water pulls back, but the landscape is forever changed. For investors, this is critical. The panic after a top is a choice. You don't have to participate. You can just observe. The urge to do something will be overwhelming. Resist it. The best action after a peak is often inaction. Wait for the new pattern to reveal itself. It always does. Markets can't stay chaotic forever. They seek a new equilibrium. Your job is to find it. For silver, the equilibrium is trickier. Its floor can be much lower, relatively speaking. It has farther to fall. This isn't a prediction. It's just how the mechanics work. Industrial demand is fickle. It turns on a dime with economic data. So while gold is pondering its new floor, silver might still be searching. This creates a divergence. And that divergence is a signal all by itself. It tells you which metal the market truly trusts in a crisis. Spoiler, it's still the yellow one. So the period after the top is a sorting phase. It separates the tactical money from the strategic money. The tourists go home, the residents stay, and the market gets quiet. That quiet is your next signal. That's when the real planning begins. But let's get practical. What do you actually watch for? I'll tell you what I watch for. First, I ignore the daily noise. The 1% swings don't matter. I watch for a failure to make a higher high. That's technical, but it's simple. When the price tries to rally and can't beat its last peak, take note. Do that twice, and a trend is in trouble. Second, listen to the chatter. When the most bullish voices on TV start adding caveats, listen. When they say long-term more often, listen. That's a shift in tone. It's subtle, but it's real. Third, watch the dollar. It's gold's old nemesis. A sustained surge in the dollar can break the rally. Not a one-day move, a real steady climb. We aren't seeing that yet, but it's on the watch list. Now, what about silver? It signals in the spread. That's the gap between gold and silver prices. When the spread starts widening wildly during a sell-off, it's a red flag. It means silver is being abandoned first. That's often a leading indicator. So you have these tools. You don't need a prophecy. You just need attention. Because the market will tell you when it's tired. It always does. The problem is, we often don't want to hear it. We're too invested in the story of forever gains. But nothing is forever. So the real answer to how much longer lies in these signals. They're flashing amber, not red. The momentum is still present, but it's becoming selective. That's the key word here. Selective. Money isn't flooding into everything anymore. It's picking its spots. That's how bull markets age. They don't die of a sudden heart attack. They fade from exhaustion, one rally at a time. And we count those rallies, we measure their strength, and we wait for the one that can't quite get there. That's the turning point. It feels disappointing. It feels flat. That's what a top feels like in real time. It's not a bang, it's a deflation. And when you see it, you'll know. But will you accept it? That's the harder question. Accepting it is the true battle. You'll have data. You'll have a feeling. But you'll also have hope. Hope is expensive in a shifting market. So let's talk about the aftermath again. What actually happens after that top is confirmed? First comes the disbelief phase. Prices fall, but the talk is all about buying the dip. This can last a while. It feels like the old pattern, just a deeper correction. Then the relief rally. It's powerful. It makes everyone think the bull is back. This is the most dangerous rally of all. It's the one that convinces the last holdouts to jump back in, and then it fails. It fails to make a new high. The failure changes everything. The narrative cracks. Now, the financial media has a new story. The story is, what's wrong with gold? Suddenly, the same analysts highlight rising interest rates, or a strengthening economy, or a solved geopolitical crisis. The reasons for the rise get picked apart. The memory is short. That's when the real decline sets in. It's not a crash, but a series of lower highs and lower lows. That's the textbook definition of a downtrend. For the average investor, it's a trap. Each low seems like the bottom. Each bounce seems like the restart. It's exhausting. And during all this, silver, it usually falls harder and faster. Its lower lows are much lower. This isn't guesswork, it's the pattern. So if you're holding through this, you need a strategy. Are you holding for a decade or for this cycle? Your answer dictates your action. If it's for the decade, you might just close your eyes. The volatility won't matter in 20 years. But if it's for this cycle, your exit plan is everything. You needed it yesterday. The time to plan for the top is before everyone sees it. That time is now, while the climb still seems endless. Because when the view changes, it's too late to plan. You'll be reacting. And the market feeds on reaction. It's a tough truth, but it's the only one that matters. So, what's a practical exit plan? It doesn't have to be complicated. First, decide what you own and why. Is it physical gold or an ETF or mining shares? Each one behaves differently in a downturn. The physical metal might just sit in your safe. That's easy. But the paper assets, they can lose value fast. Have a price level in mind where you take some profit. Not all of it, just a portion. This isn't about timing the peak perfectly. It's about taking risk off the table gradually. Maybe you sell 1/10 of your position after a certain gain. That way, you've secured some wins. Second, use a simple trailing stop. If the price falls a set percentage from its recent high, you sell. It's mechanical. It removes emotion. The hard part is picking that percentage and sticking to it. Will you get whipsawed sometimes? Yes. But will it save you from a major downtrend? Absolutely. Now, what about after you're out? Do you just wait? Not exactly. You watch. You watch for that new equilibrium we talked about. Markets don't go from bull to bear to bull in a straight line. They consolidate. They move sideways for what feels like forever. That's your next opportunity. That's when fear has truly set in, and nobody is talking about gold at the coffee shop anymore. That silence is your signal to start looking again. But you must be patient. Patience is the currency of the next phase. Impatience is what burns people after the top. They try to jump back in too soon. They mistake a dead cat bounce for a new bull. It's a common, costly error. You have to let the market settle. Let it find its new range. This can take months. It can even take years. Are you prepared for that? To sit and do nothing? That's the discipline this game requires. It's less about predicting and more about enduring. Enduring sounds passive, but in this case, it's an active choice. You're choosing not to chase, you're choosing not to panic. That takes work. Now, let's address a big psychological trap. It's called getting your money back. After a top, prices fall. Many people watch their profits vanish. Then they make a promise to themselves. They say, I'll sell when I get back to even. That is a terrible plan. It ties you to a past price that the market has forgotten. The market doesn't care about your break-even point. It has its own logic. Holding on just to get back to even can lock you into a loss for years. You have to make peace with a new reality. The price you bought at is history. Your decision now is about the future. What is the asset likely to do from here? That's the only question that matters. This is especially true for silver miners. Their leverage works both ways. They can skyrocket and they can implode. Holding a crashing miner to get back to even is a recipe for ruin. So you need a different rule. A rule that looks forward. Maybe it's a time-based rule. If the price doesn't show strength within a certain period, you move on. Or a rule based on the overall trend. If the 200-day moving average is sloping down, you're out. These tools aren't magic. They're just guide rails. They keep you from driving off a cliff in the fog. And after a major top, the fog is thick. Sentiment is confused. The data is mixed. Your own mind will work against you. That's why the rules exist. They are your co-pilot when your judgment is compromised. So, to summarize this phase, the top is a process of distribution. Smart money is quietly moving to the exits. It's handing off the asset to the retail crowd. The aftermath is a process of discovery. The market discovers a new, lower value. Your job is not to participate in that discovery. Your job is to observe it from the sidelines. With your capital intact, that's how you win the long game. You win by not losing when the tide goes out. Winning by not losing. That's the core idea, isn't it? It's less glamorous than chasing doubles and triples, but it's far more reliable. So let's tie this all back to our original question. How much longer can gold and silver go up? The honest answer is until the conditions change, and we've talked about the signs of that change. But here's a final thought. Sometimes the top isn't about the metal at all. It's about what's happening everywhere else. Ask yourself this. What if stocks enter a true, sustained bull market? What if bonds become attractive again? Where does the money in gold go then? It likely goes to chase those returns. Gold doesn't pay a dividend. It doesn't earn interest. It just sits there. In a world of exciting gains elsewhere, just sitting there loses its appeal. That's a powerful catalyst for a top, a shift in opportunity. So watch other markets. They will tell you gold's fate as much as gold's own chart will. Is that happening now? Not in a big way. But you see whispers of it. A roaring tech stock can pull attention like a magnet. Gold's climb needs a constant drip of worry and uncertainty. If that drip slows, the climb slows. If it stops, the climb stops. And for silver, it needs that plus industrial boom. It needs factories humming. It needs green energy projects rolling. That's a lot of conditions to stay perfect. So how much longer? It's a question of how long this specific recipe lasts. The ingredients are fear, cheap money, and geopolitical tension. We seem to have plenty of those, right? But markets discount the known. They look ahead. The moment the future looks less fearful, less chaotic, the premium in gold shrinks. That moment might be closer than the headlines suggest. Or it might be years away. No one knows. But you can watch for the dawn of normalcy. It's gold's kryptonite. And silver's is normalcy plus an economic slowdown. A bad combination. So stay alert to a world getting back to normal. It's the quiet signal no one talks about. Because talk is always about the crisis of the day. The end of the crisis is the real story for this trade. That's the final piece of the puzzle. And it's the one that will catch most people off guard. Being caught off guard is the default for most investors. They're focused on the storm. They forget to watch for the break in the clouds. So let's wrap this up with a clear view. The path ahead has a few likely stages. We are likely in the later stages of the climb. The signs of aging are there if you look. Selective buying, labored rallies, changing narratives. After that comes the distribution top. That's the rolling over period we described. It feels choppy and confusing. Then comes the downtrend discovery phase. This is where prices make those lower highs. Hope is slowly replaced by resignation. Finally, we reach consolidation. The market finds its new floor. It moves sideways. It gets boring. That boredom is your next signal. It means the emotional excess is gone. The asset is just an asset again, not a symbol of fear or greed. That's when the cycle can begin anew. For you, the investor, your task is clear. Have a plan for each stage. In the climb, take some profit. At the suspected top, tighten your stops. In the downtrend, stay away. In consolidation, start your research again. It's a rhythm. It's not about being right on the exact day. It's about being positioned for the entire season. Gold and silver are not stocks. They are deeper, slower, more emotional markets. They trade on primal feelings. That makes their cycles both more predictable and more extreme. You can use that. Use the emotion of the crowd as your compass. When the chatter is universally euphoric, be cautious. When it's silent and bored, be curious. We might be closer to the first state than the second. So temper your expectations now. The easy money has likely been made. What comes next is harder. It requires discipline, not conviction. It requires patience, not passion. And honestly, that's where most people fail. They can handle the storm. It's the calm after that tests them, the waiting, the uncertainty of doing nothing. Master that, and you master the cycle. Mastering the cycle is the ultimate goal. It means you're not a passenger on this ride. You have a map, even if it doesn't show every bump. So let's bring it all home. How much longer can gold and silver go up? We've built the framework. Now you have the indicators to watch. You know the psychological phases to expect. The duration is in the hands of the macro world, but the response is in your hands. What happens after the top? We've walked through that too. A gradual, then sharp revaluation. A shift from a fear asset to a forgotten one, and then, eventually, a new foundation. The key is to not be a character in that middle story. Don't be the holder through the decline out of pride. Don't be the buyer of the false rally out of hope. Be the observer with capital. It sounds simple. It's the hardest thing you'll do, because everything in the moment will pull you in. The headlines, the advice, the ticking price, your own memory of how high it once went. You must ignore the ghost of the past price. It's gone. So, as we watch this market near its possible peak, stay sharp. Review your plan, set your rules. And then, trust them more than you trust your gut. Your gut will be wrong at the turning points. That's guaranteed. Your rules are your anchor. This isn't just about gold and silver, honestly. It's about any cyclical asset. The principles are the same. Spot the aging bull. Respect the turn. Preserve your capital. Wait for the quiet to return. Then, and only then, begin again. That's the entire game. There's no magic number for the top. There's only the process of managing risk around it. You now have that process. The rest is up to you and the unpredictable waves of the global economy. Watch them, respect them, but don't let them pull you under. Good luck.